Hey everyone, ARM Holdings announced their quarterly earnings update that sent the stock price down by 10%. I'll review those numbers. I'll highlight why the stock price fell as a result of that release. I'll go over the latest revenue and profitability numbers, what's driving those numbers higher, and then I'll look at the company's forecast for the next quarter and the next year, and I'll pull it all together by comparing it against its valuation and updating my recommendation for ARM stock. ARM stock I have not had rated as a buy for 2024, and I recently updated it and told investors again not to buy ARM Holdings stock because it was too expensive. I'll update that recommendation following the stock price decrease. You're going to want to see if I'm upgrading it, lifting the recommendation higher. So let's take a look at the numbers and the story from the latest quarter.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So ARM Holdings telling investors that they delivered record revenue exceeding the high end of their guidance ranges, both for revenue and non-GAAP EPS. And this is developing as a reputation now for ARM Holdings. They give investors a range of guidance, and so far they've been beating those expectations. They've been telling you they're going to do 100 and they're actually doing 110. So they're under promising and over delivering, and they're developing a reputation for that already in their young history as a publicly traded company. The growth was driven by record royalty revenue. ARM v9 adoption continues, especially in smartphones, server, and automotive markets. The company saying that the chips based on ARM v9 technology now contribute around 20% of royalty revenue, up from around 15% last quarter. This latest generation technology is increasingly getting adopted by more and more companies, including in smartphones, servers, and smart IoT devices worldwide. According to a 2023 report by BCG, US data centers already consume around 126 terawatt hours per year, and that's expected to more than triple by 2030. Now, ARM's data center customers reporting substantial performance savings compared to legacy architecture, and this contributes to why ARM's technology is being chosen to help run these workloads. In short, AI technology and data centers are consuming massive amounts of power, and ARM's technology reduces that power usage, or it's more efficient to run and thereby lower cost to run. And so more and more companies are choosing ARM's technology because the costs of operating these data centers are rising exponentially, and ARM helps lower those costs. So they're being chosen because of that performance improvement. So for the most recent quarter, revenue came in at 928 million, which was up 47% year over year. That's excellent growth. And non-GAAP operating profit growth of 391 million, resulting in a 42.1% non-GAAP operating profit margin. Solid growth and solid profitability metrics for ARM Holdings. Now, as I mentioned, the company's developing a reputation for exceeding expectations. It told investors it was going to deliver between 850 and 900 million in revenue. It actually delivered 928 million in revenue. So 28 million above the higher end of its target. It told investors it was going to deliver 28 cents to 32 cents in earnings per share. It actually delivered 36 cents in earnings per share. So meeting and beating expectations. Now for the next quarter, investors were disappointed in the forecast. That's partly why, as I highlighted earlier, I would tell you why the stock price fell. It's because of the forecast. They're forecasting 875 to 925 million in revenue in the next quarter. At the midpoint, that would be 900 million. That would be below Q4's quarterly revenue results. And this company has been demonstrating such strong growth that investors were expecting continuous sequential growth on the top line. That's not what ARM is forecasting. But remember, they've exceeded forecasts so far. It wouldn't surprise me if they beat the higher end of this target as well in Q1 2025. Now, For earnings per share, similar story, forecasting 32 cents to 36 cents at the midpoint of 34 cents. That would be below Q4 EPS, non-GAAP. Again, investors disappointed with the forecast, but remember, they beat expectations for the last 2 quarters at least, and it wouldn't surprise if they beat expectations again. Similar story for the full year 2025 guidance. They are forecasting a midpoint of roughly 3.9 billion in revenue. That would be up from the 3.2 billion in revenue for 2024, but that wouldn't be that much growth. Let's see, at the midpoint, 800 million in growth on 3.2 billion, roughly 25% growth year over year for 2025 versus 2024. Not that great, not that great, and that would be a deceleration from the rate of growth from 2024. And the reason I'm saying not that great is because of the valuation and the prospects that were built into ARM Holdings valuation coming in. That's why the stock was so expensive, because investors were expecting robust growth from ARM Holdings. 25% growth on the top line, not that robust compared to the valuation. Now, earlier in the year, it was way more expensive. It was trading at a forward price to earnings of close to 100. That's why I told investors to avoid this stock. But now it's at a more reasonable valuation. It coincides with the more reasonable growth rate that ARM Holdings is forecasting. Now for earnings per share, it's forecasting a midpoint of $1.55, which would be 28 cents higher than the $1.27 it reported in 2024. So again, roughly 25% improvement in the top and bottom line. 25% on the top line and bottom line. That demonstrates nearly zero operating leverage in the business. When your earnings per share are growing at the same rate as your revenue, that's not demonstrating any leverage. Typically, investors like to see some leverage in the bottom line, meaning if you grow revenue by 25%, they want to see earnings per share grow by 50%. That demonstrates leverage in the business. That demonstrates that your costs remain flat and your profitability rises as revenue rises, and it's a evidence of economies in scale in the business. What ARM Holdings is suggesting here is little evidence of economies in scale in the business. This is what investors were disappointed about. This is why the stock price fell following this earnings release. Now, that's because the valuation was already stretched. If the valuation was cheap, then it wouldn't have fallen by as much after those numbers came out. Now it's trading at a forward price to earnings of 53. I highlighted earlier, around January, February, it was trading at a forward price to earnings of close to 100, which I suggested was way too expensive. And I told investors to avoid the stock, not to buy the stock. In fact, I last updated investors, let's see, on April 28th, I told investors not to buy ARM Holdings stock. I said it was a hold, not a buy. And so following these earnings results and the stock price valuation lowering, or it's now nearly half where it was, and the company's improving the top and bottom line, expecting continuous improvement on the top and bottom line again in 2025, fiscal year 2025 for ARM Holdings. They did earn an upgrade from me. I'm now upgrading this stock to a borderline buy. That's up from a hold or market perform. It's one step below a buy on my recommendation system here, and I'm updating this on May 8th, 2024. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.